been well researched and documented over the years that a significant majority of businesses fail due to poor cash flow management, which is largely attributed to inadequate accounting practices and a lack of proper financial tracking. The primary reason cited for businesses' failure is not having enough cash to cover expenses, which is directly linked to poor cash flow management. When businesses lack proper accounting systems or fail to accurately track income and expenses, it can lead to poor cash flow decisions. Understanding financial statements and proactively managing cash flow is crucial for business survival. Why am I telling you this? Because in this video, I am going to go over the 8 key steps of the accounting cycle that are essential for ensuring the financial stability of any business. Understanding the 8 steps of the accounting cycle not only helps with better cash flow management, but also forms a critical foundation for mastering business accounting and bookkeeping practices. For business owners, mastering the accounting cycle can be the difference between thriving and struggling. For accountants, understanding these steps is fundamental for providing valuable insights, optimizing bookkeeping processes, and helping clients achieve financial success. The accounting cycle provides not just a snapshot of the business financial position, but also a roadmap that supports growth and resilience in an increasingly competitive market. So let's get started. What is the accounting cycle? The accounting cycle is a systematic series of steps that companies follow to identify, analyze, and record and report their financial transactions over a specific accounting period. This cycle ensures that all financial information is accurately captured and processed. It's like a recipe for a great cup of coffee. Every step counts, and you can't skip any of them if you want the perfect brew. So let's look at these 8 steps and how they fit together like pieces of a puzzle. Here is a summary of the 8 steps. Step 1. Identify your transactions. Step 2. Record the transactions. Step 3. Post transactions to the general ledger. Step 4. Create the unadjusted trial balance. Step 5. Analyze the worksheet and identify adjusting entries. Step 6. Adjusting journal entries. Step 7. Create financial statements. Step 8. Close the books. Let's explore these steps using Bliss, a coffee shop, as an example to see how each part of the accounting cycle plays a crucial role in keeping the business's financial records organized and reliable. Step 1. Identify your transactions. The first step in the accounting cycle is to identify and analyze all financial transactions that occur during a specific period. This could include sales, purchases, expenses, or any other activity that impact the company's finances. Accurate identification is crucial to ensure no transaction is missed. For example, Bliss pays $500 for new coffee beans and on the same day sells $200 worth of coffee drinks to customers. These transactions are identified as recordable transactions during this step. Step 2. Record the transactions. Once the transactions are identified, they are recorded in the journal using the double entry bookkeeping method. In this step, Bliss records the transactions in the journal using double entry bookkeeping. Each transaction involves both a debit and a credit to keep the accounts balanced. To record the 2 transactions identified in step 1, Bliss makes the following 2 journal entries in the general journal. As a reminder, the general journal is the list of journal entries in chronological order. For the purchase of coffee beans, the journal entry is as follows. Bliss debits the inventory for $500, which increases inventory, and credits the cash account for $500, which decreases the cash. For the sale of coffee drinks, the journal entry recorded in the journal is as follows. Bliss debits the cash for $200, which increases the cash, and credits sales revenue for $200, which increases the revenue. It is important to include notes for easier identification later. Step 3. Post transactions to the general ledger. After recording the journal entries, the next step is to transfer the information to the general ledger. The general ledger is like a master book that consolidates all transactions by account. such as cash, inventory, sales, revenue, etc. Each account has its own ledger page, making it easier to track and analyze financial activities over time. When posting to the ledger, we transfer the debit and credit amount from our journal to the appropriate ledger account without changing any information. Step 4. Create the unadjusted trial balance. Next, prepare an unadjusted trial balance by listing all accounts and their balances in the trial balance. This ensures that the total debits equals the total credits. It is a crucial step to verify that transactions have been recorded correctly. Java Bliss prepares an unadjusted trial balance by listing all accounts such as cash, inventory, accounts payable, and sales revenue, and noting their balances. Let's assume cash has a balance of $500, prepaid rent has a balance of $1,200, inventory has a balance of $200, and accounts payable shows $400, while sales revenue shows $300, common stock of $1,000, and additional paid-in capital of $200. When these balances are listed on the unadjusted trial balance, Java Bliss finds that total debits equals $1,900, which equals the total credits $1,900. This balance confirms that entries were posted accurately and there are no immediate discrepancies between debits and credits. This step is crucial for verifying that no mistakes have been made before proceeding to more detailed adjustments. Step 5. Analyze the worksheet and identify adjusting entries. Step 5 of the accounting cycle involves analyzing the unadjusted trial balance to determine which adjustments are needed. These adjustments ensure that all revenues and expenses are recorded in the correct accounting period, providing an accurate picture of the business's financial status. Adjustments typically include accounting for revenues and expenses, those earned or incurred but not yet recorded, and adjusting for prepaid items like rent or insurance. This step aligns with the generally accepted accounting principles, especially the matching principle and revenue recognition principle. The matching principle states that expenses should be recorded in the same period as the revenue they help generate. And the revenue recognition principle says revenue is recognized when it is earned. For example, if Java Bliss prepaid $1,200 for a 12-month rental contract, at the end of that first month, $100 needs to be recorded as an expense. 1 month's rent needs to be recorded as an expense, reducing the prepaid rent account. Step 6. Adjusting journal entries. This step is where we make adjusting journal entries to update account balances based on the analysis from Step 5. Adjusting entries include accruals, deferrals, depreciation, and other adjustments. In the case of Java Bliss, the adjusting journal entry debiting rent expense for $100 and crediting prepaid for $100 shows the use of 1 month of prepaid rent. This adjustment ensures that the rent expense for the current period is properly recorded and the balance in the prepaid rent account is reduced, accurately reflecting the remaining benefit. Step 7. Create financial statements. Step 7 of the accounting cycle involves preparing financial statements, which are essential in presenting the financial performance and position of a business. Using the adjusted trial balance, accountants create 3 main financial statements: the income statement, the balance sheet, and the cash flow statement. The income statement shows the company's revenue and expenses over a specific period, ultimately determining profitability. The balance sheet provides a snapshot of a company's financial standing by listing its assets, liabilities, and equity at a specific point in time. The cash flow statement captures the cash inflows and outflows from operating, investing, and financing activities during a period. And finally, Step 8. Close the books. In this final step, the temporary accounts, which are the revenue and expense accounts, are closed against the income summary account. This process resets the income statement accounts to 0 to prepare for the next accounting period. This ensures that these accounts do not carry forward their balances, maintaining a clear distinction between different periods. The income summary account is subsequently transferred to retained earnings, an equity account that holds the cumulative earnings and losses of the business over time. Just for clarity, Step 8 of the accounting cycle, close the books, can be done monthly, quarterly, or annually, depending on a company's reporting needs. Most businesses do close their books monthly for better internal tracking and financial management. This allows them to have an up-to-date view of their financial health, identify trends, and adjust their operations as needed. However, they typically only perform steps 1 through 7 on a monthly basis, and the formal closing of the book, step 8, is done at the end of the financial year. This allows them to track their profitability over a 12-month period. In summary, the accounting cycle helps businesses like Bliss stay on top of their financial activities, ensuring accuracy and transparency. Mastering these steps means better financial management, fewer surprises, and a stronger path to growth. And that is all for this video. If you find this topic helpful, don't forget to like, share, and subscribe to the channel, and leave a comment below with any questions or topics you would like to learn more about. Thank you for watching, and see you next time.